Welcome to This Explainer. I am absolutely thrilled to have you here today. Consider me your personal financial advisor for the next few minutes. We're going to dive deep into a true masterclass on your retirement, specifically unlocking the full potential of your 401k. I want to show you exactly how to optimize your employer matching, choose the best tax strategies, and most importantly, avoid those massive wealth training penalties that catch so many retail investors completely off guard.
Okay, let's dive into this. Here is our comprehensive consultation itinerary designed to build and protect your future security. First, the foundation, history and auto-enrollment. Second, tax strategy, traditional versus Roth. Third, avoiding pitfalls, hardships, and penalties. Fourth, protecting wealth, the fee factor. And finally, behind the scenes, plan compliance.
Section 1, Foundation, History and Auto-Enrollment, the Evolution of the 401k. To truly understand how to optimize our deferral rates today, we really have to look back at how these accounts were fundamentally built.
Everything changed in 1978. Congress enacted Section 401k as part of the Revenue Act. And shortly after, a guy named Ted Benna brilliantly utilized this section to reduce taxes on bonuses for bank executives. Get this, at the time, the top marginal income tax rate was a staggering 70%. By deferring income, he created an incredibly powerful tax shelter. Decades later, the Pension Protection Act of 2006 revolutionized these plans yet again by making auto-enrollment a standard practice.
That 2006 legislation introduced the QDIA. Before this, employers were absolutely terrified of being sued if they automatically invested an employee's money and the market took a dive. So, by establishing qualified default investment alternatives, typically life cycle or target date funds, the Department of Labor gave employers some much-needed fiduciary relief from investment losses. For you, participating in automatic enrollment into one of these life cycle funds is an incredibly smart, diversified foundation if you prefer a hands-off approach.
But hey, auto-enrollment is literally just the starting line. You have to actively optimize it. Make sure you choose a target date fund to manage your risk timeline. Automatically escalate those deferral rates every single year. And above all else, never ever leave free employer match money on the table. Seriously, it's an instant, guaranteed return on your investment. Oh, and always designate your beneficiaries.
Section 2, Tax Strategy, Traditional versus Roth. Choosing your contribution model. Now, what's really interesting about this is how it fundamentally alters your wealth timeline. Pay taxes now or later? That's the ultimate question, isn't it? I want you to mentally project yourself into your retirement years. Just imagine the income you'll be drawing. Do you expect your effective tax bracket to be higher or lower when you finally start withdrawing this money compared to what you're paying right now? Because your answer dictates your entire strategy.
Here's the core difference. With a traditional 401k, pre-tax contributions lower your current taxable income. The government is essentially co-investing with you today, but withdrawals are going to be taxed as ordinary income later. A Roth 401k, on the other hand, takes your post-tax money. No deduction today, but your qualified withdrawals and all those decades of earnings are completely tax-free. And here's a massive detail for high earners. Unlike a Roth IRA, a Roth 401k has absolutely no upper income limits. It is a brilliant tax shelter for highly compensated professionals.
Just look at the tremendous scale of the shelter with the 2026 limits. If you're under 50, you can contribute $24,500. If you're 50 or over, you get an $8,000 catch-up, hitting $32,500. But the total combined potential when you add in employer matching reaches up to $80,000 a year. Maxing this out dramatically shifts your tax burden and accelerates your wealth.
Section 3. Avoiding pitfalls, hardships, and penalties. Protecting your principal. We're now entering the danger zone, folks. This is where wealth is most easily and tragically destroyed.
So the crucial point is understanding how tough it is to access these funds early. The IRS-approved hardship withdrawals cover things like unreimbursed medical expenses, buying a principal residence, college tuition, preventing foreclosure or eviction, funeral expenses, or repairs to a damaged principal residence. But make no mistake, while the IRS allows access for these very specific emergencies, doing so comes at a severe cost. That cost is an automatic 10% excise tax penalty. If you withdraw funds before you reach age 59 and a half, you are slapped with this 10% penalty. And listen closely, that is on top of the regular, ordinary income tax you have to pay on that money. You are heavily penalizing your past self's hard work. Now, sometimes people try to avoid this by taking out a 401k loan. But defaulting on that loan triggers an immediate taxable distribution. If you separate from service and default, boom, you are hit with both ordinary income tax and that 10% early withdrawal penalty. That double taxation trap will absolutely devastate your portfolio.
Section 4. Protecting wealth. The fee factor. The hidden cost of investing. Let's pivot to fees. This is the silent killer of retirement dreams that most retail investors completely ignore. This specific legal context shows us how critical share classes really are. The Supreme Court permits cause of action for putting 401k investments in retail as opposed to institutional shares. Institutional shares have drastically lower expense ratios than retail mutual funds, and it's your employer's fiduciary duty to monitor that.
And this brilliantly illustrates the math. A seemingly tiny 1% financial advisor fee doesn't sound like much, right? But over your lifetime, that 1% can cannibalize up to 28% of your lifetime investment returns. That is a massive chunk of your future wealth just transferred to a fund manager's pocket.
Section 5. Behind the scenes, plan compliance. Why your plan is structured this way. Welcome to the behind-the-scenes portion of our consultation. We're going to look at the complex IRS rules that employers must follow to keep these plans legal.
It all revolves around the HCE, the highly compensated employee. This is an employee who owns more than 5% of the business or receives compensation exceeding the IRS-defined threshold. They are subject to strict non-discrimination testing limits. This sets the stage for why high earners are sometimes restricted from maxing out their accounts if rank-and-file workers aren't also participating.
To enforce this fairness, we have the ADP test versus the ACP test. The actual deferral percentage ensures pre-tax and Roth contributions of HCEs aren't disproportionately higher than non-HCEs. The actual contribution percentage performs the exact same fairness test but applies to employer matching and after-tax contributions. Basically, the ADP of HCEs cannot exceed the non-HCE group by more than 2 percentage points, keeping the tax shelter fair across the economy.
Let's move on and see how this builds, because fixing a failed ADP test is a nightmare. Step 1, the employer has to return excess taxable distributions to the highly compensated employees. Step 2, process qualified non-elective contributions, or QNEs, to lower-paid employees just to raise their average. This exact headache is why smart employers rely on safe harbor matching provisions to bypass these tests entirely. So what does this all mean? Are you leaving free employer match money on the table while ignoring the hidden fees draining your future? I really want to encourage you. Review your institutional share classes, maximize your match, and choose the optimal tax strategy today. It's your wealth, so make sure you're keeping it.